You're listening to a CNA podcast.
Hello everyone, it's Junaini Johari here, filling in for Andrea. Welcome to the Money Talks podcast, where we talk about what to do with your money. If you're new here, do click on the subscribe button on Spotify, Apple Podcasts or YouTube so you'll be the first to know once a new episode drops. Before we get into the main interview, here are some quick financial updates. If you live in a condo and you're thinking, I can't wait for our site to be en-bloc, you might want to temper your expectations. According to experts, it's going to be a bumpy road ahead for en-bloc sellers. They are facing stiff competition from government land sales where the supply is high and the prices are more competitive. GLS also offers more options in terms of land size, making it more attractive to developers who may not want to buy out very large sites, because the bigger the land, the higher the costs. So it looks like these condo owners might have to take a wait-and-see approach. So last month, we spoke about how Tesla was not having a very good first quarter. Now it looks like the Chinese electric vehicle makers are also facing some troubles. What kind, you ask? Well, some of these EV makers are taking longer to pay their suppliers. According to a Bloomberg report, NIO took around 295 days to clear their payments, while XPeng took 221 days. In comparison, Tesla usually takes around 100 days to pay their suppliers. What's causing the delay? Well, low demand. China's economic growth is still sluggish, and Chinese consumers are not spending as much as they used to. It also doesn't help that A, China had phased out their national subsidy program for EV purchases in 2022, and B, there's a price war with other EV makers around the world. So, a note to investors who are looking into the booming Chinese EV market: do practice some caution first as the EV saga continues.
This is the Money Talks podcast. I'm Andrea Heng. So, Singaporeans, we like to play it safe, right? We assess risk in a very plain, very simple manner. It's either safe or not safe. And we really don't like the grey areas because we are just not fans of uncertainty. But investing has many grey areas, and they are constantly evolving, whether we like it or not. And this is, of course, because it's dependent on market and economic conditions. And in order to successfully navigate such an undulating landscape, we do need to take some risks. So are we losing out on potential wealth by being too conservative in our investments? We'll try and understand this better now with help from Jo-Ann Chia. She's Senior Portfolio Manager for Fixed Income at Nikko Asset Management. Welcome to the Money Talks podcast, Jo-Ann.
Morning, Andrea. Thanks for having me.
It is our pleasure. So, no secret that Singaporeans are a conservative bunch, even when it comes to investing. So, I have to start with the most basic question. Why are we so conservative? Why are we so averse to risk?
I think the conservative nature of Singaporeans was quite apparent in a recent survey done by the Straits Times. And they found in the poll that across both young and older investors, the top choice of investments is in fact fixed deposits, followed by government bonds. I think the most obvious reason why is that these are very easy to understand because like what you see is what you get. 3% fixed deposit over 6 months. When the fixed deposit matures, you can just either roll it over or put it into another bank with a higher
because
return,
it looks like a sure thing, right?
Yes.
Okay.
Yeah, essentially risk-free.
Yeah.
As well as Singapore government bonds. So risk-free, easy to understand. But I think more about why, then it has to do with the Asian culture. We tend to be more conservative in nature and not just in investing. Also in the way we conduct ourselves, social behavior. We tend to be more reserved versus our Western counterparts. And also in our lifestyle choices, we are less risky in nature. And so for Singaporeans specifically, risk aversion is practically entrenched in our Singapore culture. Because from young, we are taught to save money in the bank, and then we're given these little bank books to track our bank balances, right? And also, parents tend to be more protective of their children. And also the formal education system that we go through, we are taught the model answers
Yeah.
to get the best marks in the exam.
I remember those days. I do not miss them. I really do not miss them. But you know what? I think they're trying to change that. At least in the education system,
For
we
sure.
are trying to change that. So hopefully it means fewer risk-averse investors in the next generation. Who knows, right? So I'm glad that you brought up the fact that the investors here, they do prefer fixed deposits because it's as good as a sure thing. It's very low risk or no risk at all. I guess then it's not surprising that FDs are a top choice for us, right? Why is this still the case even as we see Singapore having such an open investment ecosystem where you can buy almost any stock, including the more exciting, adventurous, also known as volatile ones. So why do we still want to stick with safety nets?
I think for one is the nature of Singaporeans, like we talked about earlier, and also financial education.
Right.
I think many Singaporeans might not have the knowledge of how to invest. And so while they might not be naturally extremely risk averse, the lack of financial knowledge and education, despite the many options out there, might lead them to put things in fixed deposits as well as government bonds.
Yeah, it's one thing to be risk averse, but not being exposed to different ways of doing things. And especially when it comes to money, we're very hesitant because we are just not informed enough, right? Okay, regarding the Singaporean investor behavior from a Legg Mason survey back in 2015, that survey showed that Singaporeans are pessimistic about their investments. But the thing is, as we said earlier, there is so much more access now to retail investing. And then there was the rise of crypto as well, which we'll get to in a moment. But now that there's this greater accessibility, democratization of investing, right? Do you think that this pessimism has changed among Singaporeans?
Okay, I might not think that pessimistic would be the exact word to use. I think for a long time, we've been in a period of low interest rates, whereby putting money in fixed deposits gives you a bit better return than cash.
Right.
And because then returns were so low. Right now, we are in a period of much higher interest rates and fixed deposits of over 3% is something that we haven't seen in a long time.
Yeah.
So it might not be necessarily something that Singaporeans are pessimistic about, but also could be their future. They might not be too sure about what the future holds, how things would change.
Uncertainty.
Yes, because of the rising cost of living and all sorts of changes going on in the world.
Oh, absolutely. Geopolitics is a very big influence in financial markets, and it trickles down to sentiment as an investor as well, Okay, so I've also read that Singaporeans prefer to be product focused for their investment portfolios as opposed to asset allocation. They've also been found to hold substantial amounts of cash as savings or emergency funds compared to, say, American investors, right? Which have more robust portfolios, they're a bit more adventurous, they're a bit more watchful of what's happening in the dynamic market. Does this then point to a cultural or psychological barrier to optimal investing, or do you think it's because of the kind of financial advice and products that are marketed to our market specifically that make us think that, oh, this is just our bubble? We'll just stick to this because we're familiar.
I think you brought up two very interesting points. First of all is the cultural difference, and secondly is the product focus. First of all, Westerners, they tend to be much more adventurous and risk-seeking by nature. And so given the availability of the types of sectors, the types of different platforms, and the different types of alternative investments available from the United States, naturally there would be better demand for such products in the US. Whereas for Singaporeans, I think we tend to have a very strong trust in our banks as well as in our financial advisors. So many of the products might be coming from banks or through their personal financial advisors. So that they rely on these expert advice rather than from expert advice from social media, for example, and place their money and trust in such products.
So it is both a cultural thing as well as the lack of variety. Do you think that will change though? Do you think the Singaporean approach to it will change if we, say, started to have the kind of variety that we see elsewhere in the Western world?
I think the availability of investments within Singapore might be limited to Singapore companies, but Singaporeans can always invest outside, invest globally, invest into cryptocurrency, into US stocks as well. So I think generally we are opening up to such investments. And even nowadays with social media, the younger generation definitely trying to dabble into such investments as well. Yeah, and they just want to follow the hottest tip.
I tell you, it's social media, okay? There's no escaping it. Even if you get yourself off the grid, someone else is going to talk about it to you, right?
Yeah.
And I'm so glad that you brought that up, because the next group of people that I want to really zero in on are the Gen Zs and the young millennials. This is coming from an OCBC survey that came out recently. The first thing was non-traditional investments. So you mentioned crypto, NFTs are part of this as well, digital investments, right? They no longer as popular among investors in their 20s. So it was as if there was this tidal wave that was very short-lived. All right, people were getting into it, especially the younger crowd. The second thing that really caught our eye was the fact that about 20% of the Gen Zs and young millennials are getting their financial advice from, like you said, social media. What does this tell you about their investment interests and, more importantly, their risk appetite?
Okay, pertaining to cryptocurrency, I think back in 2016, 2017, started to pick up and get more popular. But then there was a cryptocurrency crash that probably many people got burnt from. And so people might shy away from it right now. But it's starting to pick up again. And so market tends to be forgetful. And, once things start to pick up again, you might start dabbling
the
back
moment
into
there's
it.
a new chance to make money, who won't jump on it, right?
Exactly. Back to your other question.
About risk appetite.
Risk appetite. I think what you mentioned earlier as well about the younger generation reading up on social media, financial advice from the internet rather than doing their own homework or research. I think this is definitely more common nowadays. In fact, there are so many financial bloggers out there. And I don't think it's something bad, because some of these financial bloggers put things forth in very easy language, easy for them to understand, and it makes sense. But of course, they may not all be correct advice. And so ultimately, when investing, there's still the risk. You, of course, have to do your own homework and understand what exactly you're investing into. In terms of risk aversion, given that they are young and have a pretty long way in terms of investing or time horizon, I think they can afford to make some mistakes along the way. So I think it's a period of experimentation and finding out. But ultimately, I think it's very important to really understand what you're buying into.
Of course.
Because chances are, if you make money from buying something you don't understand, you might think you're actually very smart. And if you lose money, there might be a tendency to think that you're just unlucky, But, when you actually buy something and you lose money, but you do understand what you're buying into, at least you can take a step back and assess why you made such a mistake and potentially avoid such losses.
So it's really
again.
understanding the value of that lesson rather than, hiya, I just made a mistake, or, oh, yes, I made a lot of money, let's continue and pump more in, right? You know what? I have to admit, I don't know what this feels like, because I never had this exposure to easy investing when I was their age. It's such a vast and fast world that I feel like I cannot catch up. But I think your advice is classic advice. So there's another survey that says that more than half of the high net worth individuals in Singapore have increased their investments in safer assets. So we're talking about cash, we're talking about gold. And I find this surprising, because you would think that those with more wealth, that wealth must have come from something more exciting, more aggressive, or something a bit more complicated. So it was quite surprising to find that a lot of them now are shifting to your safe haven assets. My question now is, do you think that we, being generally more conservative, more risk averse, are more heavily invested in these safe havens than investors anywhere else?
Okay, I think there are a few parts to this. In the past, the common mentality of Singaporeans in terms of investing, besides safe products, would be to invest in property.
Yes.
So I believe many of these high net worth individuals might have made a lot of their wealth from property.
Yeah.
But nowadays, with the taxes and property becoming so expensive, property is no longer the top choice of investment.
The favorite's not the favorite anymore.
Exactly. So I believe also many of these high net worth individuals might be closer to their retirement years.
Yeah.
And so the focus would be more on capital preservation and risk minimization rather than trying to accumulate more wealth.
So it's more a risk aversion because of the stage of life that they're in, right? That maturity. So let's say we want to start thinking about being less risk averse. What are some of the first questions we need to ask ourselves, apart from, are you ready?
Okay, I think being risk averse is not necessarily a bad thing.
Okay.
Because some people are naturally inclined to be less risk averse. And if they were to buy something that's very risky, then the last thing you want is for them to be overly anxious or not being able to sleep well at night. But I think the most important thing is financial literacy, understanding of the products available, and ultimately investing according to your risk appetite. So the next question is, what's your risk tolerance? What's your risk appetite, right? And while most of us might have a sense of whether we are more risk averse or more risk seeking in general, the idea or concept about risk level or risk appetite is a bit abstract.
It is, and it's subjective, right?
So one way that we can think about it is to put our objectives or our financial goals in quantifiable terms.
Sure.
So for example, this would be like, I would like to make my first million by the age of 30.
Okay.
Or I would like to have this amount in my account for retirement so that I can live comfortably over my retirement years. So from there, we can work backwards to see how much rate of return we need to get from now to then in order to meet our financial goals. Then the other question is about risk tolerance. Because investing is not risk-free, right?
Yes.
It entails risk. And so the idea of risk tolerance is how much you are potentially willing to lose in order to achieve your financial gains. And so the risk objectives as well as the tolerance, they have to be in sync for one to be able to invest correctly. And of course, working out these numbers might be difficult for some people. So you can either engage professional help or right now there are many forms of AI investing through robo-advisors whereby they ask you a list of questions and you provide answers based on your profile and risk tolerance so that your assets are allocated automatically through algorithms and all so that they invest according to your risk appetite in order for you to meet your financial goals.
Oh, that's great. So the barrier to get started is not intimidating, not like it used to be, right? Not like it used to be. Okay, so when it comes to investing, a common piece of advice that I get always comes down to this. If you're not sure, if you're new, start small. So let's say starting small is already in the pocket. How will I know then when it's time to go higher?
I think this really depends on the individual according to each person's risk tolerance and everything. So first of all, you have to set aside what amount you are prepared to invest, what amount you are prepared to lose while investing. So that would be your level of risk tolerance.
Yes, correct.
And from there, how much risk you're willing to take and what assets you want to put the money in based on what rate of return you are likely to receive. Because, of course, when you start small, the temptation is to keep chasing the market upwards. But once the market drops, it's quite scary. Many people don't know how to cut loss and get out of the market at the right time.
And it's really hard to stomach that.
Yes. So essentially, only invest what you're willing to lose. That would be the most basic and sound advice across all investment types and across all investors.
Exactly. It's the simplest thing, but it's the hardest to do sometimes, right? Especially like you said, that temptation is there. I know you alluded to this earlier, but ultimately, it's being a conservative, risk-averse Singaporean investor a bad thing? Am I really going to be losing out on substantially better channels of earning wealth by sticking to my guns and just playing it safe? Is it really that bad?
It's ultimately being able to invest according to your risk appetite. And if you're risk averse by nature, capital preservation, accumulation of one's wealth slowly, as well as risk minimization might be the way to go. So there's nothing wrong with that. But I think with better financial education and understanding what's available for you, you would be able to invest better according to your risk appetite rather than investing in the safest products just because you don't know what's out there.
Yeah, that's the key, right? The financial education.
Yeah.
I think we definitely can do better in this respect. And this is exactly why we have guests like you on the Money Talks podcast. So thank you so much. This was really enlightening, and I hope it inspires us to be a little bit more courageous with the right kind of homework and research and, of course, professional help. I think we can make it happen. So thank you so much, Jo-Ann.
Thanks, Andrea.
All right, so before we let you go, there's the fun part of the Money Talks podcast. It's called Questions from a Hat. So I need you to pick one of the questions and I'll read it out for you. Okay. Your question is, what do you spend the most money on, Jo-Ann?
Okay, I like to shop a lot, but...
Oh, you know what? Jo-Ann, you are not alone. You are in the same room with the right person here.
Yeah, but it would not be wise to say that we spend most of our money on shopping.
Yeah.
I mean, as part of our household, I think most of the monthly expenditure actually goes to household expenses. As boring as may sound, we have our mortgages to pay, we have our leases and everything. So most of the money will go there. So any additional expenditure would probably go towards personal enjoyment like shopping or
you know what?
Traveling.
Ain't no shame in that because it's our hard-earned money. I think it is perfectly sound financial advice to treat yourself once in a while and within your financial means.
Always a good balance.
Yes, always a good balance. Always budget for your hobbies, okay? Jo-Ann, thank you once again for being on the Money Talks podcast. And to you, listener, thank you once again for following us. And if you have any thoughts or questions about this particular episode or any other episode, send us a message, okay? This podcast is available on Apple Podcasts, on Spotify, as well as YouTube Music. Don't forget to rate us if you are enjoying the podcast. My thanks to the Money Talks team, Jo-Ann Chan, Tiffany Ang, Crispina Robert, Junaini Johari, and Sai Ye Wint. I'm Andrea Heng. Thank you for listening to Money Talks.